Imagine a product. It produces nothing. No factory, no raw materials, no workers. But this product generated more wealth than every fortune ever accumulated in human history. It financed wars, destroyed empires, enslaved nations, and you, your family, your friends, everyone you know and everyone you don't, are all using this product, without even realizing it. That product is debt, and debt is not the innocent financial instrument you have been told it is. It was designed deliberately, step by step, over centuries, to become the most profitable product in human history. Debt, in its purest form, is a promise, a vow. Take today, give back tomorrow. But buried inside that promise was a single hidden word: interest. And interest changed everything. Because interest opened the path to turning the future into today's profit. For thousands of years, society struggled with this idea. In ancient Mesopotamia, people recorded their debts on clay tablets. But those same civilizations understood the danger of debt. Every 50 years, a debt jubilee was declared. All debts were erased. Slaves were freed. Everything began again from zero. Why did they need such a thing? Because leaders had noticed something. If too many people became enslaved by debt, not just individuals, but the system itself would collapse. In the Hebrew Bible, debt forgiveness is commanded every 50 years. The idea was simple. Debt was dangerous. It had to be controlled. Otherwise, it could enslave entire communities. And at that point in history, those at the very top understood this truth and erased the debt. Then something changed. Those at the top discovered how debt could be used as a weapon. In medieval Europe, the Catholic Church had officially banned usury, but bankers found the gray areas around this prohibition. They disguised loans as trade contracts. They developed financial instruments so complex that none of them looked like debt on the surface, and that was clever enough. Because the ban was against the name of debt, not the reality of it. By the Renaissance, powerful banking dynasties like the Medici family in Florence had built their empires not on land or armies, but on lending. They lent to kings, they lent to popes, they lent to merchants. What did they want in return? Not money, power. Debt was no longer just a financial product. It had become the backbone of power itself. The real transformation came in the 17th century. When the Dutch Republic was fighting for independence from Spain, it raised money by selling bonds to its own citizens. This seemed like a simple innovation, but its consequences were groundbreaking. Investors could buy government debt, receive interest payments, and trade those bonds like property. Suddenly, war was no longer limited by the gold or silver sitting in a king's treasury. It could be financed indefinitely by selling the future. The Dutch perfected this model. England copied it. The creation of the Bank of England in 1694 formalized national debt as a permanent institution. The state was no longer borrowing only in emergencies. It was living on debt, rolling it over indefinitely. And those who managed this debt became indispensable to the crown. Debt had been promoted from private contracts to the very foundation of state power. The profits reached enormous proportions. Lending to governments is the safest path in the financial world, because governments can raise taxes to pay their creditors. Wars that once would have bankrupted monarchs could now be financed indefinitely, and those wars expanded empires, opened new markets, and created new opportunities for more debt. It was a perfect loop. The more nations went to war, the more they borrowed. The more they borrowed, the more powerful their creditors became. By the 18th and 19th centuries, the bond markets in London, Paris, and Amsterdam had become the beating heart of global finance. Armies marched, ships sailed, countries were conquered, all of it fueled by borrowed money. But this was not just a game played by nations. As industrial capitalism spread, ordinary people were drawn into the cycle too. Railroads, factories, infrastructure projects, all built on credit finance through bonds and bank loans. Workers earned wages from companies funded by debt. Then those same workers borrowed to buy homes, tools, and eventually consumer goods. Debt seeped into every layer of economic life. By the 20th century, debt was no longer just a tool of governments or powerful merchants. It had become an everyday product sold to the masses. Mortgage, car loan, credit card, student debt. The entire architecture of modern life was built to normalize borrowing as the default condition of existence. And this is where debt's hidden genius, or hidden cruelty, reveals itself. Debt does not generate profit only once. Every interest payment is a transfer of wealth from debtor to creditor, from the many to the few, repeated month after month, year after year. Unlike a product you buy once and use, debt is designed to be permanent, to lock you into a cycle of payments that never truly ends. A house bought with a 30-year mortgage will cost 2 to 3 times its original price. A credit card bill rolled over month to month can grow faster than your ability to pay it. What began as a promise becomes a trap. Debt is the most successful business model in history. It requires no factory, no inventory, no raw materials. It generates wealth from time itself. And those who understood this earliest, the merchants of Amsterdam, the bankers of London, the financiers of Wall Street, became the architects of the modern financial system. This system does not manage debt. It manufactures it, expands it, and depends on it to survive. By the middle of the 20th century, debt had stopped being a tool used only in emergencies. It had become the lifeblood of the global financial system. The Bretton Woods Agreements of 1944 were celebrated as a new era of international cooperation. The IMF and the World Bank were founded to lend to nations in crisis or development, but behind the lofty rhetoric was a simple mechanism: debt as discipline. Countries could borrow, but only on terms dictated by their creditors. The IMF, dominated by the United States and Europe, began attaching structural adjustment conditions to its loans. Entire national economies were told what to cut, what to privatize, and how to reorder their budgets. Debt was no longer just profitable. It had become a lever of political control. Nations that borrowed too much found their sovereignty compromised, their policies rewritten, not in their own capitals, but in Washington or Basel. The rhetoric was about stability and growth. The reality was dependency. At the same time, a quieter revolution was happening in the daily lives of ordinary citizens. In the decades after the Second World War, banks discovered a way to sell debt, not just to governments and corporations, but directly to households. The mortgage became the crown jewel of middle-class aspiration. Home ownership, once reserved for elites, was suddenly possible for millions, but only by signing a contract that chained families to 30 years of payments. Car loans, furniture installment plans, and eventually the credit card transformed debt into a consumer product marketed like any other. The psychological shift was enormous. Debt was no longer shameful or rare. It became the normal way to participate in prosperity. Buy now, pay later. Enjoy life today. Let the future take care of itself. For banks, this was a gold mine. Interest from millions of households produced steady, compounding profits. For governments, it created the illusion of endless growth, as consumer demand could be fueled by credit even when wages stagnated. For corporations, it guaranteed a steady stream of customers who could be enticed into spending money they did not yet have. Debt became the hidden engine of modern capitalism. The danger was that the entire system became addicted to expansion. Banks did not want debts repaid quickly. They wanted them rolled over, refinanced, extended. The longer people stayed indebted, the more profitable they became. Governments learned that borrowing was easier than raising taxes. Politicians could promise benefits today and push the cost onto future generations. And central banks, with their power to create money, made it all possible by ensuring there was always enough liquidity to keep the wheels spinning. Debt was no longer a temporary bridge. It had become the permanent architecture of the financial system. By the 1970s and 1980s, the consequences of this addiction were impossible to ignore. Developing countries across Latin America, Africa, and Asia had borrowed heavily in the boom years, encouraged by Western banks eager to recycle petrodollars after the oil shocks. When interest rates rose sharply under Federal Reserve Chairman Paul Volcker, these nations suddenly found themselves unable to service their loans. The debt crisis exploded in 1982 when Mexico announced it could not pay. The solution: more loans under harsher terms managed by the IMF and the World Bank. Debt became a trap. You borrowed to survive, then borrowed again to repay, and with each cycle you lost more control over your economy. Ordinary citizens faced austerity, inflation, and unemployment. Elites and creditors collected interest. Meanwhile, the financial industry discovered new ways to package and sell debt itself. Mortgages, car loans, and corporate bonds were bundled into securities that could be traded globally. Debt was no longer just a contract between borrower and lender. It had become a commodity in its own right, sliced, diced, and sold to investors everywhere. Wall Street became less about producing goods and more about engineering debt instruments. This process, called financialization, turned credit into the most important raw material of the modern age. The profits were staggering. A bank could originate a loan, sell it to investors, and move on to the next one, collecting fees at every step. Risk was supposedly spread around, but in truth it was only hidden, waiting for the next crisis to reveal it. The 2008 financial collapse was the logical outcome. Trillions in mortgage-backed securities, built on the premise that American homeowners could never default en masse, imploded. Debt had been stretched beyond reality, and when it snapped, the entire global financial system trembled. Governments stepped in, not to punish the sellers of bad debt, but to rescue them. Once again, it was proven who the system was really designed to serve. Ordinary families lost homes, jobs, and savings. Banks received bailouts. And when the dust settled, the use of debt did not shrink. It grew. The very crisis created by debt became the excuse to create even more of it through central bank interventions and ultra-low interest rates. Debt was no longer just profitable, it had become indispensable. Every part of the global economy depended on it. Governments funding deficits, corporations financing stock buybacks, households keeping up their living standards. Without constant borrowing, the system would collapse. Debt had become the product that sustained everything else. Endlessly sellable, rollable, inflatable. After 2008, central banks slashed interest rates to zero and flooded the system with liquidity. They promised this extraordinary medicine would restore stability. But what it really did was supercharge the addiction. Cheap credit encouraged governments, corporations, and households to borrow even more. The numbers are staggering. Global debt today exceeds $300 trillion, more than 3 times the world's annual economic output. Never in history has so much of humanity owed so much to so few. And the greatest irony is this: this mountain of obligations is celebrated as growth. Politicians point to rising GDP while quietly knowing that much of it is simply borrowed from the future. Debt has become so normalized that we hardly question it anymore. A 20-year-old takes on tens of thousands of dollars in student loans. It is sold to them as an investment in their future. A couple signs a 30-year mortgage. It is marketed as a dream come true. Governments run deficits year after year. Voters barely notice because the consequences are invisible in the short term. Inflation is the hidden tax that makes repayment possible, silently reducing the value of money in people's pockets while preserving the nominal power of the debt system. What looks like prosperity is often just leverage stacked on leverage. The most striking feature of this system is how it concentrates wealth. Every interest payment is a transfer from debtor to creditor. Over time, this funnels money upward, from millions of households paying credit card bills and mortgages, to the balance sheets of the largest banks and investment funds. Debt does not just generate profit. It reshapes society. It locks in inequality. Those with assets can borrow cheaply to buy more, turning wealth into greater wealth. Those without assets borrow expensively, trapped in cycles of repayment. Debt becomes a mirror of class division, polished and legitimized by the financial system. And now, as central banks explore central bank digital currencies, the next evolution of debt is already on the horizon. Imagine money that is programmable, traceable, and controllable at the code level. Loans approved or denied automatically based on algorithms. Interest rates adjusted in real time, penalties enforced instantly. To many, this sounds like efficiency. But if the history of debt teaches anything, it is this. Efficiency for the creditor means less freedom for the debtor. The most profitable product in history is being upgraded for the digital age. And once again, it will be designed in committees and conferences far from the public eye. So what is the lesson? Debt is not neutral. It is not a simple tool for progress or a natural feature of modern life. Debt was deliberately cultivated as the most profitable product ever created, a product that turns time itself into money, a product that transforms the hopes of individuals and the struggles of nations into streams of interest payments flowing upward. To understand debt is to understand that financial freedom cannot be handed to you by the system, because the system thrives on keeping you indebted. Real wealth means minimizing your dependence on borrowing, questioning the promises of easy credit, and recognizing that behind every loan offer is a machine designed to profit from your future. History does not repeat, but the pattern is always there. From the clay tablets of Mesopotamia to the mortgages of suburbia, from the Dutch bond markets to Wall Street's derivatives, the story is always the same. Debt enriches the creditor, burdens the debtor, and reshapes the world in favor of those who control the flow of money. And the cruelest trick of all is this: we were taught to celebrate it. We were taught to call it progress. We were taught to mistake borrowing for prosperity. If you want to uncover the hidden secrets of history, you are in the right place. By subscribing to the channel, you can get one step closer to the truth.